Good evening and welcome to what is F8 revision March 2017 sitting. That's quite difficult to say, it turns out. And this is revision class number 2 out of 4. On Monday, we revised ethics, a reminder that there are 5 fundamental principles, and then we focused on confidentiality and when you must or might breach it and report stuff about your client to some external body. We looked at conflicts of interest between 2 clients and how you might deal with those. And the most important bit of ethics in terms of the marks that tend to be available is we looked at threats to objectivity and the safeguards that audit firms can put in place to manage them, remembering that it's not just knowing the various types of threat, self-interest, self-review, advocacy, etc. If you get a written question on it, which you might, probably MCQs, but if you get a written question, being able to explain why things are threats. But we also looked at the first core area of the 3 big ones. We looked at audit planning and in particular risk response. We had a reminder of what the audit risk model is and how it works. But far more importantly, we looked at 2 examples of practical audit risk questions. The main focus was on the audit risks themselves and how to explain them. Remember, most audit risks are risks of material misstatement, the risk the accounts are wrong. So what you need to be saying is which items in the accounts you think might be wrong, which direction, over or under, and why. We also noted that there are 2 slightly different types of question, and the first one we looked at was a written scenario, and the second one had a written scenario plus it then had some numbers, and you had to calculate some ratios. Now that question is up on our screen just here. We did the ratios, reminder how to do those calculations, no problem there. And I showed you the various potential audit risks that I was spotting from what was happening in the numbers, and then we went and read the story and found some more audit risks in there. The question does also require responses to risk. So just to remind you that if you do, for example, think, as I did, that if receivables days are increasing as they were, this might suggest that those older balances imply that they will be harder to collect, suggesting that receivables are overstated because they should have some stuff written off. What would my response be? Well, my response is what I want my audit staff to do to check whether this risk is reality. How do we know if the balances at the year end are indeed a risk of non-payment? And we know if they're a risk of non-payment by looking for evidence that there is a problem. So I'd be looking at correspondence between my client and their customers for any evidence of disputes, maybe even the financial statements of the customers. To see if there's any indication that those companies are in trouble. Remember, accounts are publicly available documents. But that question is pretty much the same as the first one we practiced, the only difference being that because you've got the numbers, there are some calculation marks available. And if you've got the numbers themselves can tell you about audit risks, not just the written story. There is also a technical part to this question, and I don't like ignoring anything when we're looking at past questions. Whoops. And that technical part there, just above my head, in part A. For 5 marks, which normally means you're looking to make 5 points, says explain the concepts of materiality and performance materiality in accordance with ISA 320, which is the materiality audit standard. 5 marks available for explaining 2 things. So the main technique thing here is to look at the marks available and plan yourself how you would get 5 separate points. We've got to explain materiality and we've got to explain performance materiality. Materiality is a far easier concept than performance materiality, and with 5 marks available, one of those 2 things is likely to get you 3 marks and the other 2. So why not push to get 3 marks on the easier concept, materiality? Well, surely you'd want to say anything that can affect how users view the financial statements and make decisions based on the financial statements is going to be material. In other words, it's important to the shareholders. Well, that's the base level definition, so that should be a mark. And then I remember, since I need to say more things, because there's more than 1 mark available, that things can be material by size, e.g. greater than 5% of PBT, or by nature, e.g. directors' pay. And that should get me a 2nd mark. But I'd like a 3rd mark out of materiality. Now, other things I could say would be that it is set at the planning stage, but is subject to change during the audit, because the numbers that you use at the planning stage to do your assessment are not the final accounting numbers, and by the end of the audit they may be different, meaning materiality would need to be different. There are other things I could say as well about materiality. It is a matter of the auditor's professional judgment. There's no right or wrong way to do it, for example. But if there's 5 marks available for explaining 2 concepts, I doubt you're going to get more than 3 for any one of them. Because if you want to get 4 or 5, you've got to have a go at both. So I'd go for the easier one first. Performance materiality tends to be a figure that is lower than overall materiality. So I'd want to make that point. Why is it lower? To reflect that if X dollars of mistakes are found in a sample, and we sampled, let's say, I don't know, 25% of the population, errors in the population might be 4 times X on the basis that you've tested 1 quarter. But it could easily be 5x, 6x or more. because samples are never going to be perfectly representative. So if you said materiality is $1 million, I've tested a quarter of something, therefore if I find 250 or less, I'm just about okay, because that's 1/4. You're running on the assumption that if you find, say, 200 in the population, it's 4 times that 800, because you tested 1/4. Well, it might be 800, but it could easily be 900, 1 million, and then you're over materiality, aren't you? So it would make sense to bring your bar down a bit. It also reflects the fact, if there were more marks available, which there aren't, it helps to build in a safety margin for the errors the auditor does not spot. Now I could go on and on at this if I wanted to. The only real point I'm making here is, with this sort of stuff, you either know it or you don't. So if you're staring at all of this going, I could never, well then you won't write it, will you? But if you know it, brilliant, but then look at the number of marks and let the marks determine how much you then write. But anyway, any bit of knowledge from the course could come up in a long question requiring you to explain it. Most of it will be tested in MCQs, but anything could come up. Will that come up? I don't know. Who knows? Anything could. The most important thing we've practiced in the last 2 questions we've done are the risks and the responses, because that always seems to come up. Right, we will move onwards then. We will move onwards. We need to take a look at the second core area, which will be internal controls. But just before we get to that, a little bit of technical revision just to make sure we're covering enough bases. Now, as you can tell by the length of my silence, this is an audit standard area which has got a rather long and annoying title. Those charged with governance, for the purposes of your studies, we can assume to be the audit committee. And if your client has an audit committee, presumably because they're a listed company, and you are the auditor, I would imagine the audit committee and you, the auditor, are going to be talking to each other. And you may well get a question that says, what sort of things are you likely to be talking to them about? The answer is anything and everything. But because it's anything and everything, very helpful, Paul. What does that mean? What's the actual answer? Well, the way I would look at this is I would tell you, think through the stages of the audit process and from those stages we'll just think what are the most important things. So when we study F8, what are the stages of the audit process? Well, there's the ethical considerations before we're even taken on as auditor. We then plan the audit, which is primarily about risks and responses, as we've just done. The next core area is controls. We then collect the evidence. And we finalise. And we report. So what are the key things that happen on our course? Because if they're happening and they're important, I think we should be discussing them with the audit committee. Well, at the ethics stage, it's about threats to our objectivity and the safeguards we plan to put in place. So if you do find threats to objectivity, you don't just deal with them in your audit firm and keep quiet about it. You discuss these threats with the client's audit committee so they are aware of the threats and they can judge if what you're doing about them is appropriate. When we plan the audit, we should discuss with the client the main risks of material misstatement in the financial statements. Partly so they know what we're doing during the audit, but also because the audit committee may well want to contribute to that and say, we think this is a risk as well. We would need to talk them through what we're going to do about this in the audit so they know what our planned responses are. And that may well then lead to discussing the timings and the resources for the audit that you are expecting to use. I'm going to put this one on here, although strictly speaking, I did write at the top of the screen ISA 260, and this one is actually covered in a separate audit standard. But it's also a communication point, as we're about to see in the next core area. If we find significant control deficiencies, we should be discussing those with the client and making recommendations on how to improve them. Then we go and collect the evidence. If we have any problems getting hold of evidence, we should tell the audit committee. And of course, if we find misstatements in the accounts, we should tell the audit committee. Finalisation and reporting. Well, at the finalisation stage, we're doing all sorts of interesting stuff. We're assessing the company's going concern. So I suppose any going concern threats that we've identified. I would want to talk the audit committee through the list of uncorrected mistakes. So the things that the finance director so far hasn't corrected. And I would want to talk them through my proposed draft audit report before the shareholders see it. So the committee understands why I'm coming to the conclusions that I have come to. How many have I got up there? 1, 2, 3, 4, 5, 6, 7, 10. You're never going to get a 10-mark question for this. I think the last time I saw it, it was worth 5. But I've never bothered learning that list. I've just thought, think audit process and just describe the main things that happen at each stage. Because that's what you're going to end up talking the audit committee about. So there we go. That is ISA 260, communicating with audit committees. Now we've got that little bit of technical stuff out of the way, and I will tick it off on my checklist. Why am I ticking it off on my checklist? That is an internal control over this course to make sure that everything I plan to do, I do, and that I've got a record of what I've done so I don't end up doing it again, as that would look a little bit silly, wouldn't it? So let's move on to core area number 2. By March the 6th, you guys need to have some knowledge. You need to know things like the 5 main reasons companies have controls: safeguard assets, reduce fraud, business efficiency, accurate management accounting information, reduce the risk of breaches of laws and regulations. But there's no point me writing that stuff down. It's in the class notes, it's in the textbook, it's everywhere. This is stuff you've just got to get into your head. You need to know what the 5 elements of an internal control system are, you know, control environment, procedures, etc. You might be asked what the limitations of control systems are. Why aren't they perfect? Human error. Staff collude to get around the controls. Management override the controls. Staff won't do controls because they don't understand the purpose of them, can't see the benefit. And controls tend to get out of date very quickly, meaning they don't work because they should have been updated to better reflect how things work at the moment. And documenting controls, which if my memory is right, came up last sitting, so probably won't for you. And that's things like questionnaires, narrative notes, and flowcharts. Oh dear, my handwriting's gone horribly wrong there, hasn't it? So there's a little bit of knowledge in this part of the course, but the majority of the marks are going to be for practical. Which means, do you know how to come up with control objectives, control procedures, and tests of control? Because as long as you know how to come up with all three of those and you know the differences between them, whatever she asks, you should have no problem getting sufficient marks. And as maybe you remember from the teaching phase, the most favoured type of exam question on controls that helps to test from as many angles as possible is the report to your client on control deficiencies. And her favourite way of testing that at the moment seems to be you have to explain the deficiencies in their system, which means first of all you've got to find them by reading the story, and then you've got to explain them, and you've got to recommend improvements. She might then at the end of the question ask you what control tests you would do to check that the improvements that you've recommended are now in place and working. Okay, so on that practical stuff, let's start with objectives, procedures, and tests. When we did this during tuition, I teach it in logical thought order. Your examiner is not going to set a question that says objectives, then says procedures, then says tests, necessarily. She could test any one of them or test them out of order. So, to check we get this, what if I was to say to you, part A of a question, control procedures over payroll. Part B of a question is control, hang on, let's write this the examiner's favourite way, tests of control over purchases. Part C, control objectives over sales. 3 questions, and not in the nicest thought order. Now, if you're watching this as a recording, I suggest you stop the recording right now and you have a go at those 3 things in that order, A, B, C, and see if you can do it. So what would I do? I would say, okay, part A, says control procedures. Procedures are the things companies do to achieve control objectives. So what are control objectives over payroll? Only pay people for the hours they actually work. Only pay people if they are genuine employees, not fakes. Your payroll data in the accounts would want to be accurate. That's an objective too. Procedures, therefore, for payroll. How do I know I'm only paying for hours worked? As a company, I would have physical observation of staff clocking in and out, possibly by the use of CCTV. How do I know that staff who don't clock in and out but fill in a timesheet are telling the truth? I don't know. I would have departmental managers check and sign off staff timesheets before they get paid. I would also have departmental managers review the draft monthly, weekly, whatever it is, pay list. To see if figures look sensible for each employee. Those are all control procedures. They are things a company could and should do. What was B? Tests of control over purchases. Well, a test of control is an auditor checking that a control procedure is working. So I need to think of control procedures over purchases and then think how I would test them. Control procedure over purchases, when goods arrive, check them for quality to make sure they are not damaged. As an auditor, how would I know that goods are checked for quality when they arrive? And I think that the auditor would observe the goods in process to verify client staff are checking quality as goods arrive. The company should be checking that the goods arriving are the things they ordered. So the auditor could inspect goods receive notes to verify signature showing client staff checked goods in equals what was ordered. So control procedures are what client does. Tests of control are what auditor does to check client's procedures. And part C, I suggested control objectives over sales. Control objectives over sales. Objectives are what you want to try to achieve. So they should all work if you say to ensure. What do we want to achieve with sales? That we only sell to customers on credit if they are likely to pay. To ensure all orders are fulfilled as soon as possible, because that keeps clients happy. to ensure the invoice add up. To ensure we only invoice for the goods we supplied. You must practice thinking about this before exam day, because something here is coming up. And if she asks for one of those three things and you do one of the other two, you will score nothing. Don't fall into that trap. If you know what you're doing, this is not hard. And to sort of prove that, we're going to have a go at some Control-Z type questions. And the first one we're going to look at is from June 2015. And it's question number 2. If I can find it. Is that it there? There we go. June 2015. Some nice old style MCQs on there for you to practice. Question 1. I think is the ethics question we did. Is it the ethics question we did yesterday? Maybe not. But another good example of a threats and safeguards question. But we've done all that already. Let's look at question number 2. And 2 part A says identify and briefly explain the 5 components of an entity's internal control. It's only worth 5 marks, so it's 1 mark per component. You'll get half for identifying and half for explaining. So the 5 components, as mentioned earlier, you'd need to talk about control environment, often referred to as the tone at the top, the attitudes, awareness and actions by management and how they pass those down through their staff. You'd need to talk about the control procedures themselves, so the authorization, the reconciliations, the physical controls, etc. The information system. The risk assessment. And the monitoring by internal audit. All you'd need is a sentence each on those, and that should be plenty. But that's knowledge, and you can get the knowledge yourself. What you're paying me to do, I hope, what you're paying me to do is show you how to do the thinky questions, the ones where you need some method. Part B, describe a test of control. The moment you see the word control in a requirement, stop reading. Get your head straight. A test of control is what an auditor does to check whether a control is taking place. And generally there are 3 ways of checking if a control is taking place. We can ask the client staff, enquire. We can inspect signatures on bits of paper, suggesting a check has been done. And we can observe the actual control taking place. And sometimes we can't physically observe a control without forcing the control into action by making it happen. So we might need to use something called test data, a computer-assisted audit technique, a fake transaction to make the computer do something, to see if it does the right thing. Now, if you get your head around that, whatever it says in the rest of this requirement, you should now be getting close to 5 out of 5. Because if you know what tests of controls are, this shouldn't be hard. With a question like this, people tend to get 4 or 5 out of 5 or nothing. Because instead of doing tests of control, they do control procedures or control objectives. Describe a test of control which the auditor of bond-side trading would perform to assess whether or not each of the non-current asset controls listed above is operating effectively. Now that's helpful. It means that this story is going to tell us at least 5 control procedures happening in non-current assets. All we've got to do is check if those procedures are working. Since it's on the screen, let's start with the one at the bottom. Apparently, access to the non-current assets register is restricted through passwords to a small number of staff in the finance department. How would I know that that is true? With apologies to Whitney Houston, rest in peace. How would I know that only a certain number of passwords can get into the asset register? I would have thought the most obvious thing to do is try to access the asset register using the passwords of unauthorized staff. That is, in effect, an example of test data. You are faking an attempt at entering the asset register to see if you can get in. What's the next one? I mean, that seemed pretty straightforward, didn't it? Periodically, internal audit undertakes a review of assets in the register and compares them to the assets on site. So they go around looking for the assets to make sure they exist, using the serial number to confirm existence of the asset. So I'm guessing every asset has got a number put on it, which links to the asset register. How would you know that internal audit is indeed doing that? I think I would observe internal audit as they do an asset check to register, verifying they compare serial numbers. Now, is it me, or is this easy? Yes, if you've worked out what a test of control is, because otherwise you could go off down a whole different direction. Does it carry on being easy? When the asset arrives, a GRN is completed, which details the nature of the expenditure, and the GRN classification is reviewed and initialed by a responsible official. Inspect GRNs to verify that that signature is present. You could even, I suppose, go and inspect some of these invoices. You decide if it's capital or revenue, and then see if the responsible official has agreed with the same conclusion. Reperforming this might give you some assurance that whoever did it in the first place at the company is doing it right. This is easy. Copies of the GRNs relating to capital expenditure are then submitted to the Finance Department for updating of the non-current assets register. Is that a control procedure? I'm not sure it is. I think if we have checked GRNs to make sure that initial is there, and we've looked at the GRNs that the Finance Department have got, because we know they shouldn't have got to the Finance Department until they've been initialed. As long as the Finance Department's copies are initialed, I think we're okay. 3 down, 2 more needed. On receipt, each asset is assigned a unique serial number. Is it now? And this is recorded on the asset and in the non-current assets register. Observe arrival of assets to verify this happens. Go and pick a sample of assets and check that number 1, there is a serial number on it, and number 2, it is the same number that is in the asset register. It does also say a unique serial number. So I would use some audit software perhaps to rearrange the asset register in serial number order and check that there are no 2 assets that have the same serial number, because it does say unique, so we should check that control. Now there is another one, but come on, this is easy, as long as you know what a test of control is, and that is the key point. We are now going to head straight into another question on the same exam paper, because on this exam you got those 10 marks on controls, and then question 4 was another controls question. And this time it's the traditional one. 5 deficiencies in the system we're about to read. Make a recommendation to address each of these deficiencies. From my experience, students are normally good at finding the deficiencies, but just in case you're not, key things to look out for are anything the client is not doing, because if they're not doing it and you're told that, I presume they should have been doing it. Look out for the word clerk. Clerks should be doing what they are told. Fairly basic operational tasks. They should not be making any decisions, changing things on the system. Low level. If you see anything that it says is being done manually, could it be automated? If you see anything that is done verbally, it should probably be documented. That will help you to identify them. It does also say explain them. When you explain a deficiency, you need to explain it in terms of the bad things that could happen to the company as a result. So think damage. In technical terms, a bad thing means your control objective is not being met. So what she's testing here is, do you understand control objectives? Damage to the company could be things like upset customers, falling profits, increasing the chance for fraud, and things like that. And then it says recommend. Well, when you recommend, there is a danger. The danger is, it says in the question, goods are not checked for quality when they arrive, and you recommend goods should be checked for quality when they arrive, and basically just rewrite the story slightly differently. When you recommend, try to add something. Say who should do it, how should they do it, how often should they do it. Add some detail. Apart from that, this is all about practice and practicing what I've just said in blue and green up on that screen. So don't just practice them, practice the technique. We need 5 deficiencies and we need 5 recommendations. So as so often we do on this course, this paper, I put the deficiencies on one side, the recommendations on the other side. And if we find more than 5 deficiencies, I will, as always, choose the 5 I think are easiest to explain and for which I can come up with a sensible recommendation. So let's go through the story and see what we can find. Whoops, not that one though. That one. Cherry Blossom, manufacture custom-made furniture, year-end 30th April. Company purchases its raw materials from a wide range of suppliers. Below is a description of their purchasing system. Okay, here we go. Production supervisors require raw materials. They complete a requisition form. Sounds good. And this is submitted to the purchase ordering department. Good, so they can't just buy things themselves. The ordering department will do it for them. That's good because the ordering department, I presume, can buy in bulk. They can plan the timing of orders, negotiate discounts, make sure they've got good quality suppliers, stuff like that. Requisition forms do not, thank you examiner, require authorization, and no, which is like not, reference is made to the current inventory levels of the materials being requested. Well, those two are so easy, they would go straight into my answer. Deficiencies. No authorization of requisitions. Well, that's just copied from the story, so I want to start adding to this as soon as I can. Means staff could be ordering items for their own personal use, causing unnecessary cost to company and therefore reduced profits. So notice my consequences are trying to focus on why the company would be damaged by this. Recommendations. It would be so easy to write authorize requisitions, but we want to say more. Who, how often? Let's just go back and see what the lovely question said. Requisition forms do not require authorization, so production supervisors fill in a requisition form. They don't require authorization. Well, if a production supervisor is putting in this requisition, we'd need someone more senior than them to do it. So if you're going to say who, I don't know, production director maybe? How should they authorize this? I mean, how would they know that what's being requested is needed? How often should they do this? For everyone? Every single requisition? Because what I'm thinking to say is something like this. Who should do it? Maybe the production director. So there's who. How should they do this? Should compare requisitions over time and to budgets so there's an attempt at how. To check if requisitions appear excessive. I might also say that any over, I don't know, X dollars should require individual authorization. And that appears to me to be an attempt at saying how often. So with that one, I've tried to do all three things to really give it some value and avoid just repeating the deficiency in reverse. There was a second one in there, wasn't it? No check to inventory before requisitions turn into orders. And again, I don't want to copy too much of the question out because you're not going to get much for copying. If inventory not checked, items might be ordered. That are already in stock. Leading to increased waste, and as a result of that, lower profits. It's so easy to now write inventory should be checked. Fine. Who? How? How often? Well, how often? Every time, I would hope. Who? How? Well, I think we're past the olden days when you would walk into the warehouse and just have a look. Bit like you and I would do if we're going to the supermarket. You go and look at what's in the fridge before you go. Wouldn't a company have a computerized inventory system, which when inventory got down to a certain level would automatically place an order for new items. Couldn't we suggest that? That would be a nice how and who. Get the computer to do it. Reorder levels. Remember studying that on another paper? Should be set, I think it's on F9, isn't it? Should be set within inventory system so that orders are automatically placed when inventory levels hit the reorder level. That would do it. Now, I think spotting those two should be fairly easy, so it's just how you explain them and coming up with a recommendation that does more than simply repeat the deficiency. Excuse me. Back to the question we go. Staff in the purchase ordering department use the requisitions to raise sequentially numbered purchase orders. Good. Based on the approved suppliers list. Good. You see there are strengths in here as well as deficiencies, and sometimes an exam question will ask for strengths. Which was last updated 24 months ago. So turning that around, it has not been updated within the last 2 years. I think I've got a third one. So quickly identify it. Approved supplier list not updated for 2 years. Okay, so what? Meaning company might be missing out on cheaper and better suppliers meaning profits are lower than they could be. Who, how often? Who should be updating the approved suppliers list? Purchasing director, I would have thought. How should they do this? They should go to all existing suppliers on a regular basis, I would say at least every year, maybe even every 6 months, and look to improve the deal. But they should also go to alternative suppliers and offer them the chance to pitch for the business. So how about on an annual basis? So there's the how often. The purchasing director. So there's the who. Should put key supplies, so the things you buy on a regular basis, out to tender, inviting current suppliers to offer improved terms, which they might or might not, and compare with other available suppliers. So you see what I'm doing here? Trying to add some detail. I don't think you necessarily need to do all three things I've tried to do there, but the more you try, the more ideas I think you'll find will come out. 3 down, 2 more needed, and I'm still in the first paragraph. There's 2 other paragraphs coming. The purchasing director authorises the orders prior to them being sent to the suppliers. Okay, well, that's a strength. We've already tried to improve that by saying the purchase director should be looking at the requisitions before they even turn into orders. I might be tempted to say that the purchasing director shouldn't authorise all orders because some will be relatively small and should probably only authorise above a certain level. But that looks pretty strong. It only needs a slight tweak. And I've already got 3 out of the first paragraph, and I feel I want to move on and pick stuff out of the others. When the goods are received, the warehouse department verifies the quantity to the supplier's dispatch note and checks that the quality of goods received are satisfactory. Good on quality, but I don't like their check on quantity. All they're doing is checking that the quantity supplied matches what the supplier's documentation says. On that basis, I could send that company anything I like, and as long as I include a piece of paper describing it, that's all they're going to check, which means then they'll end up paying me even though they never ordered these items. Surely what they should be doing is checking that the goods coming in are the things that they ordered in the first place. So how do I put that into writing? Why is that a deficiency? By only checking quantities to supplier delivery documents, no check is happening that goods were actually ordered. Company at risk of paying for items they never wanted, which of course would further reduce profits. You are paying for things that you never needed. What do I suggest as a recommendation? Well, the recommendation is pretty straightforward. On receipt, check all goods in to purchase order to verify right goods are arriving. Then sign goods received note to show check done. Now I've said how this should be done. I've said how often, all. Naughty me, I didn't say who. I think warehouse staff could do this, couldn't they? I mean, if I was running this business, I would send the warehouse staff at maybe the beginning of every week all the recent purchase orders that we're expecting to arrive so that when things arrive they can check them against the orders. Pretty obvious. 1, 2, 3, 4. I only need one more. They complete a sequentially numbered goods received note. Good. And send a copy of the GRN to the finance department. Good, because we want the finance department to check when the purchase invoice arrives that it matches the goods that were received. I wonder if they do. Purchase invoices are sent directly to the purchase ledger clerk. Okay, clerk should be doing basic stuff, yes? Who stores them in a manual file until the end of each week. Why? That means until the end of the week, your accounts are out of date because they don't show the liabilities of the company. He then inputs them into the purchase ledger using batch controls. That's an example of an application control. What batch controls means is that if he submits, I don't know, let's say 25 purchase invoices, at the end the computer will say, you've submitted 25 invoices totaling 3,768,000 and tell you the total, and you then compare that to your own manual total, having added them up, to check that what you've put in looks like it's been inputted correctly. So that's another strength. Inputs the purchase ledger using batch controls and gives each invoice a unique number based on the supplier code. No, purchase invoices need to be sequentially numbered. Because if you don't sequentially number them, how do you know they're all on the system? You wouldn't see gaps, would you? The invoices are reviewed and authorised for payment by the finance director. Good. But the actual payment is only made 60 days after the invoice is input into the system. Well, if you pay everything 60 days afterwards, there must be some potential payment discounts that might be attractive that you're going to miss out on. And what if the supplier wants quicker payment than 60? If you keep paying suppliers late, because that's what you do, you're going to upset them, and then they might go off, and then you might not be able to get those suppliers anymore. Seems to me there are several deficiencies in that final paragraph. I'm not going to write anything more out because I think you get the point. All you got to do is pick any one of those, explain the consequences to the company, upsetting suppliers, lose suppliers, might not be able to get the goods, disrupts production, and then make a recommendation, which is instead of 60 days for everybody, you should agree payment terms with individual suppliers, and if any prompt payment discounts are offered on an invoice, somebody senior should be looking at that and making a decision as to whether it's worth paying earlier to get the discount. Someone senior, purchasing director, finance director maybe? Finance director, I reckon. Well, my friends, we have done two 10-mark questions, so a 20 marks worth of effort on internal control so far. And it seems to me that both of those questions on the same exam were not exactly complicated, as long as you know what tests of control are and you've practiced deficiency and recommendation questions and explain deficiencies and add who, how often, or something similar on the recommendations. Wonderful! Isn't this going well? I hope you're getting some confidence that these questions are very doable as long as you've thought about the techniques and you've done a bit of practice. You don't need to know much to be able to do these long questions. You need to understand, have practiced, and have a proven technique that works. And that's my job, to show you those techniques. Well, we haven't finished on internal controls yet. Not at all, in fact. But I think we need a little break from internal controls for a minute or two. And a little look at some of the other knowledge on the exam that might come up. So let's have a little audit standard at this point, and I think we'll jump forward to the end of an audit. And look at something called other information. Audit standards tell auditors what their responsibilities are during the audit process. So what you need to know for the exam is what are the auditor's duties relating to other information, which means our starting point has got to be, what is other information? It is the unaudited stuff. Sorry, stuff's a very horrible word, isn't it? The unaudited documents attached to the audited financial statements. And in the vast majority of cases, what we're talking about here is the company's annual report. So that document, produced typically by listed companies, that has things in it like the chairman's statement, the CEO's report, social and environmental data, corporate governance stuff, these days I suppose an integrated report, all sorts of stuff. The fact is, it's not the financial statements. What are the auditor's duties? Well, this stuff is not audited, so you don't have to audit this stuff, but you do have to read it. Why? Because it might contradict, in other words, be different from information in the financial statements. And if that's the case, shareholders reading the annual report and the financial statements would get confused. And we wouldn't want that to happen. So you're going to read what's in this other information. And if the information in there is different to what you've seen in the financial statements, and assuming you've audited the financial statements, and you know the financial statements are right, it must mean this other information is wrong. Then you will need to ask the client to correct the other information. If they correct it, yay! Job done. Confused shareholders? Not at all. If the client refuses to correct the other information, then what is the situation we have? Well, the situation we have is the financial statements are fine, they're true and fair, and if they are true and fair, in your audit report, you will have an unmodified opinion. Because the financial statements are not a problem. And the opinion is on the financial statements only. We did audit reports on tuition right at the end. I wonder if you can remember that there were 7 possible changes that can be made to an audit report. 4 of them are about modifying the opinion, and we've just said we're not doing them. We've got 3 left, and those 3 are additional paragraphs that can go in to an audit report without changing the opinion. And 1 of those 3 paragraphs will be required here. Because what we're going to do is add what is known as an other matter paragraph. In the audit report, to tell the shareholders about the contradiction. So I'd expect it to say something like, in the 4th paragraph of the chairman's statement, the chairman refers to whatever the chairman refers to. Profits have doubled this year. However, profits in the statement of profit or loss have not doubled this year, and based on our audit work, we believe the statement of profit or loss to be true and fair. Or something like that. And there we have it. That is ISA 720, other information. One of many audit standards which might perhaps possibly come up as a 4 to 5 mark explanation within one of the longer questions. Well, we have reached the halfway point in revision class number 2. We need to go look at another exam question shortly, but before we do that, I think that is a perfect time for us to have ourselves a little break. It is currently 7:14. We will take a 15-minute break at that point. So I guess we will restart. Let's make it 16 minutes and keep it a nice round number. At 7:30 UK time, I will see you then. sorts of rules here. Right, there you go. Thank you. Okay, welcome back everybody, with apologies for the delay. As you may be able to hear in the background, we have got ourselves the good old moaning air conditioning unit again. In the room, it is switched off, but despite that it is still making a lot of noise. There is absolutely nothing I can do about it whatsoever. We can't reschedule the class because there is nowhere to reschedule it. So I will carry on. I'm hoping, given where the noise is happening, is a little way away from the microphone. I'm a lot closer to it. I'm hoping that you can hear me relatively clearly, and it's more of a problem for me having this noise than it is for you. So apologies, but there is absolutely nothing I can do. And with any luck, our maintenance department will do something about it before the next class. Right. We have been looking at internal controls. One of the keys to getting better at something is repetition, preferably with a gap, and then come back to it and do it again. So I've got another question lined up for controls, but we're not going to do it right now. We're going to wait until class number 3 and see if the repetition with a break in between helps you. So what am I going to do now then? Well, to help us out for something we are studying a little bit later in revision, I'm going to remind you of some knowledge. And once we've got through that, I'm then going to move into core area number 3 to finish off tonight's class. The sooner we get all 3 core areas looked at again and questions practiced, the sooner we are making the progress we need. But before we get to that 3rd core area, let's have a reminder of how audit reports work. Now, you remember, and I hope appreciate, that audit reports have changed relatively recently. Auditing does not change much at all. I've been doing this for well over 20 years. Auditing doesn't change. So for audit reports to have changed in a relatively big way is big news in the world of audit, and therefore big news for your examiner, who is likely to test it more often because it's new. There are 2 things for the exam that you need to be comfortable with audit reports: describing what goes into them, so the content, the structure, and then looking at scenarios and coming to the right conclusion. So firstly, a reminder of the contents of a standard audit report. They start not with an introduction and a title. That doesn't make any sense, Paul. They start with the title, as most things do, of course, and the addressee. So, report of the independent auditor, title, to the shareholders of XYZ company, the addressee. And it would help if I did that and then you could actually see what I was writing. Then we get the first big important thing, the opinion. Whether the accounts, in the auditor's opinion, are true and fair. Immediately following that, we get the almost as important basis for opinion. The basis for opinion means how did you get to that opinion? So, for example, you followed international audit standards. We will then get a brand new section, Key Audit Matters. Only required if the company is listed on a stock exchange. And the remainder of the standardized content is not very exciting and therefore less examinable even. Responsibilities of the directors and the auditors. So directors are the ones keeping the accounting records and preparing the accounts, and the auditors are checking and giving an opinion on them. And then it finishes off with the auditor's signature, the date of the audit report, also the location of the auditor's office, so which city it is in. And there you've got the basics. But rather more interesting than the basics are the non-basics, the stuff that comes up in questions. So there is potential, as I said earlier, for 3 extra sections that you need to know about. And those 3 extra sections are 3 of the 8 possible audit report outcomes that we can get. So what I propose we do now is revise the various outcomes we can get, and then we'll go back to the contents and show where those extra paragraphs might go. So as I said, you may well get a question where you have got to look at what's going on in the story and describe the outcome in the audit report if nothing else changes. What would happen? There are 8 possible outcomes. There is the unmodified report. There are 4 potential modifications to the opinion section. And then unmodified opinion, but an extra paragraph and there are 3 of those. So if we have an unmodified report, what does that mean? It means the financial statements are true and fair. Sufficient audit evidence has been collected. And there are no other issues that the auditor feels needs to be mentioned. There are 4 possible modifications. And the best way of remembering these is in a 2 by 2 table. There are 2 levels of problem called material and pervasive, and I'll talk more about what those mean in a minute, and 2 types of reason for changing the opinion. The financial statements are wrong, or there is a lack of evidence. When we say material issue, we typically mean something which is material to shareholders but only affects a small number of balances. When we say pervasive, we mean it affects most of the financial statement balances. Because if something only affects a small number of balances, we are able to explain it and then say, except for that, the accounts give a true and fair view. So both of these two are known as except for opinions, because we use the words except for. And the official language is that makes them a qualified opinion. So for 2 different reasons, we can get a qualified opinion. If the financial statements are wrong and it affects most balances, then we are going to say that the financial statements do not give a true and fair view, and that is known as an adverse opinion. If, on the other hand, we are lacking evidence about most of the balances in the accounts, then we cannot form an opinion on the financial statements because we lack too much evidence, and that is called a disclaimer. So those are your 4 modified opinions. And whenever you have a modified opinion, the explanation of that modification will be in the basis for opinion section. And then we have the 3 extra paragraphs that can happen. So the opinion is not touched, and instead we add another paragraph to the audit report. And since I'm beginning to run out of space on the screen, I will go and explain this bit below. Two of these involve an important but correct disclosure note in the company's financial statements. The other one is not about the financial statements. It's where there is something not correct in the company's annual report. So there are our 3. Now the blue one, of course, we saw earlier on tonight when I revised ISA 720 with you and other information, because this is the other matter paragraph. And the most likely example you'd see of that on the exam, based on recent experience, is where the chairman's statement has some sort of error in it. But above me here, we've got the black stuff. It's important but correct disclosure note in the financial statements. So the accounts are right, but there's something that's been disclosed, some sort of explanation, which the auditors are very keen that the shareholders must have seen. Whoops, sorry, wrong colour. If it is a material going concern uncertainty, we get one answer. If it's not a going concern uncertainty, we get another one. If it's a material going concern uncertainty which has been disclosed in the financial statements correctly, what we end up with is what I like to call a MERG paragraph. Now this is brand new, and I have to admit I have invented that. I've not done much invention, it's just the first letters of what this paragraph would be called. But it is a material uncertainty relating to going concern, or as I said, what I like to call a MERG paragraph. If it's not a going concern uncertainty, it's going to be called an emphasis of matter paragraph. Now in both cases, on the black side of the screen above me here, on both cases we are emphasising something in the accounts. But going concern is the biggest issue out there for shareholders. Will the company survive? And as a result of that, going concern gets separated, it gets its own special title, but more importantly, it's not just that it gets a different title. The MERG paragraph goes higher up in the audit report than an emphasis of matter or an other matter, because it will go directly under the basis for opinion. Whereas the emphasis of matter and other matter must go lower than that, but exactly where they go is up to the auditor. So you don't need to know a location for those. But the MERG paragraph, if required, must go directly under the basis for opinion. Before we look at a little example to help the understanding here, before we get to the questions on reports, which don't think I'm planning to do tonight. I'm just trying to remember if I've got one that's got one in, actually. Maybe we have, maybe we haven't. We will see. Let's have a look at key audit matters. Only relevant for listed companies. And what the auditor is required to do is explains for all matters discussed at length, so significant matters, with the client's audit committee What were the issues? How did the auditor test those issues? And the conclusions that were reached. What is the point of the Key Audit Matters section? Well, before Key Audit Matters came along, this is what would happen. Auditors discover big mistake in the accounts, have huge argument with client isn't keen to change it. Finance director say no. So the auditors would go to the audit committee and say, look, your finance director doesn't want to change this. The fact is we think it is wrong, and if they don't change it, we're going to have to say something in the audit report. You manage to persuade the audit committee that you are right. They have a chat with the finance director, and after a lot of back and forth and arguments, finally the finance director says, okay, and the accounts get changed. What would the shareholders have heard? The answer? Nothing. The audit report would have said the accounts are true and fair, because now, of course, they are. Well, it's long been said that if there's been a big debate about something in the accounts, which is maybe quite subjective, matter of opinion, two people think two different things, if it really caused that much fuss, shouldn't the shareholders be told about the argument and the fuss that it caused? And that's basically what Key Audit Matters is aiming to do. The auditors need to tell the shareholders what were the big arguments on the audit and how did they get resolved. Which I have to admit sounds like a very sensible thing to include. Okay, let's have a little example. The example I'm going to use is by far, I think, the most complicated example I could come up with, but it helps to prove point. Let's have audit reports and going concern. A. Your client seems to be a going concern. But a material threat to its going concern status exists but client has not disclosed this threat. What is the likely outcome in the audit report? Well, let's think it through. Let's go for modified opinions. Have we collected enough evidence? Well, if we think the client's a going concern, we can only think that if we've got the evidence collected, so I presume we have. Are the accounts wrong? Yes, because they should have disclosed this. Next question, is it material or pervasive? Well, all the numbers in the accounts are okay, it's just one disclosure note missing. And I would therefore suggest this is probably material, but not pervasive. Probably. As a result, qualified opinion, except for, and as with all modified opinions, if you're changing the opinion, you would explain the missing disclosures in the basis for opinion section. Okay, so there's one example. Let's try it different. B. Same as A. but the client has disclosed the threat in a financial statement note. Well, if that's the case, the accounts are right. They've done what they need to do. As a result, my audit opinion will not change. It will be unmodified. Meaning, all I've now got to do is ask, are any of those 3 extra paragraphs required? And the answer is yes, because we have got a correctly disclosed material uncertainty relating to going concern. I will therefore add a merg paragraph directly under the basis for opinion, and that paragraph will highlight the financial statement note that the shareholders should go and read, and clarify that the audit opinion is not modified as a result of this. It could be modified for other reasons, but not because of this. Now, I'm trying to save a bit of time, cut a few corners, and I'm calling it a merg paragraph. The first time you write this in an answer, you would have to put all the words material uncertainty relating to going concern, but then put brackets and call it merg afterwards, and then you can call it merg from then on in. Let's try something different. Your client has used the going concern basis to prepare their financial statements, but the auditor thinks client is not a going concern. Well, if that's the case, the financial statements are not correct. But it's not just going to affect one balance. The whole basis of preparation of the financial statements is wrong. And that makes it pervasive. And that means an adverse opinion. The accounts do not give a true and fair view. So there are some examples of potential audit report outcomes using going concern, which I like to use to help explain it because it helps to show when you affect the opinion paragraph, when you have to add the merg paragraph, etc. One more thing I'm going to try. Auditor thinks client, which is listed, by the way, which probably tells you where I'm heading with this one, is a going concern. Auditor spotted a threat to going concern. Discuss this at length with the audit committee. And then concluded that the financial statements needed no disclosure note. Okay, let's be careful here. Needed no disclosure note. I suppose I should add, and there's no mention of the threat in the financial statements. Well, if the auditor thinks no note is needed, and there is no note, the financial statements seem to be correct. And that means I won't be modifying the opinion. Do I need any of the extra 3 paragraphs? Well, the extra 3 paragraphs are for either highlighting a disclosure note in the accounts, which is correct, and there is no disclosure note to highlight, or there's a mistake in the other information, and there's no mention of other information here. No extra paragraph is needed. However, because it's a listed company, there will be a key audit matters section. And since this going concern thing was discussed with the client at length, with the audit committee, that therefore means that the going concern threat should be described in the key audit matters. Now, I appreciate it might be difficult for you to do this, but try and take a step back from all of this and see what's happening. If they get going concern wrong, we'll be mentioning it in the opinion. If they get going concern basis right, but should have disclosed something, meaning the accounts are wrong, we'll explain it in the opinion. If they get going concern right, and there's a threat, and they do correctly disclose it, we'll leave the opinion alone, but we'll have a standalone paragraph called a merg, making absolutely sure the shareholders are aware of this disclosure. Even if we've spotted a going concern issue, but we've agreed with the client it's not quite significant enough to warrant a disclosure note in the accounts, but it was significant enough that we at least wanted to discuss it with the client, we will tell the shareholders that we discussed it with the client. What does this all mean? It means that the only way going concern doesn't get mentioned in the audit report is if there are no signs of any sort of threat at all. If there's a threat, but the client persuades you it's not quite significant enough to go in the accounts, it will still get a mention, if it's a listed company, in the key audit matters. And then as it gets gradually more important, notice it will appear higher in the report, because the merg is above the CAM. If the accounts are wrong, that's above a merg. So there's a prioritization thing happening here in the audit report. The biggest issues will go in the top and change the opinion. Interesting stuff in the accounts that needs to be highlighted is likely to go next. Stuff that was concluded as okay, but caused a lot of debate with the client, will be described next as key audit matters if it's a listed company. Whew. Now, I've said this often about this paper, especially on tuition for those of you who were on there. I think most things you learn on this paper are not really that complicated. I think audit reports is a bit complicated. It needs some time for you to go through the rules, and the more important thing you've got to do is think up situations and make sure you're getting to the right conclusion. Okay then, onwards and upwards we go. We're only on revision class number 2. We're not even halfway through revision yet, but I would like to introduce the third and final core area that you need to practice. Substantive procedures. Auditors collect their evidence in 2 ways. We test controls on the basis that if the controls are working over the preparation of the financial statements are probably fairly accurate. But we also need to test the numbers and disclosures in the accounts directly by getting supporting evidence to see if the stuff that's in the accounts looks about right. So forget about the process anymore. Let's go and check the actual output of that process the content of the financial statements. And if we are checking for mistakes in the accounts, we need to be aware that there are several types of mistake that we need to test. And it's those types of mistake that lead us to the assertions. An assertion is a claim. And when the finance director hands you the draft financial statements, the FD is claiming or asserting that none of those types of mistake have been made. One slightly good piece of news is that recent changes mean that the assertions are a lot more similar between profit or loss and statement of financial position than they ever were in the past. We need to check completeness. Everything that should be in the accounts is in there. Turning that around, we need to check that everything that is in the accounts should be in the accounts. So the events and transactions in the profit or loss occurred, they took place. The assets and liabilities exist. But just as these two are clearly the same, these two are the same. They're two different words for the same concept. Is the thing that's in the accounts real? We need to check that everything has been classified correctly. In other words, under the right account heading. It's gone into the right T account, if you like. We need to check everything has been presented correctly. So things like not netting things off. So you can't net off revenue and costs, or you can't net off receivables against payables. Making sure things are either separately disclosed, where they have to be separately disclosed, or have been aggregated together, as and when necessary. And I must apologise, I've been very naughty. I was trying to have a colour scheme here, and I failed completely. Classification, presentation. Do you know what we're going to do? Let's be consistent. So, okay, one of the words is slightly different, but the concept's the same. So far, they're the same. And the fifth one is pretty much the same as well. We need to check that the numbers are correct. Oh, Paul, come on. Ding, 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 ding. Again, slightly different words, but it doesn't really matter. For your understanding, you are checking numbers. So far, 5 principles that seem to be the same. The last one on each list, different. Because with profit or loss, we need to make sure that things are put into the correct accounting year, and that's called cut-off. And that is certainly not the same as the last one on the statement of financial position, which is we need to check rights and obligations, or if you want to make life simple, that the stuff that they've got on their statement of financial position does belong to the company. So we have got to test all those lovely assertions. How do we test them? Strictly speaking, if you were to read ISA 500, the audit standard on collecting evidence, it will tell you there are 7 types of procedure. The examiner has never asked for all 7 in an answer. She's only ever asked for 5. So as long as you know at least 5, you're going to get all the marks. And for the purpose of coming up with substantive tests, which is the thing that always comes up for lots of marks, all of us tutors have found over the years that the easiest one to remember that will give you a method for coming up with ideas is called AEIOU. 5 different types. We can use analytical. We can ask somebody a question, but that will only be of any benefit if we get an answer. We can inspect things. We can observe things. And the one that is a total cheat, we can recalculate things. But it means we've got A, E, I, O, U, which of course are the 5 vowels in the English language, which hopefully makes it easier for it to stick in your brain. Now I think there's one other little list that might help you come up with audit tests. And that is, oh dear, I'm having a technology breakdown tonight, aren't I? And that is, let's do it over here, the 5 types of evidence that could be involved in your tests. And that one is my list, DA-3. So a lot of audit evidence involves looking at documents, inspecting assets, asking the directors to confirm things, or asking someone outside the company, third parties, to confirm things, and sometimes looking in the accounting books. And I know, because I have practiced this so many times, that if I can think assertions, AEIOU and DA-3, I can come up with a lot of tests very quickly. In terms of the exam questions you are likely to face on this area, what sort of stuff are you going to get? Well, one type of question is she will simply say, what substantive procedures would you do on a company's trade receivables or trade payables or tangible non-current assets, or sales revenue, purchases, payroll expenses, inventory. Just pick a number from the accounts. Or she might tweak that slightly and ask you for tests for a specific assertion for one balance. Or I suppose test a balance using a specific type of procedure. And from experience, if she does that, it's almost certainly going to be analytical. Now, what's in the middle of the screen there is harder, because you can't just go all out with any test whatsoever. If it's not testing the assertion she mentions, or it's not the right type of procedure that she mentions, you won't get marks for it. So if you don't understand the assertions, if you don't know what an analytical procedure is, you are in big trouble. And then the other type of question we get is she gives you a little story. And if you're asked to test a short scenario, My advice for that is check every fact, date, amount that is mentioned in the story. Now, you will know I am not a fan of trying to learn every test for every balance in the accounts. If you do that and the short scenario question comes up, it doesn't work anyway because you've got to be specific to the scenario. And if you learn every test for every balance, you're looking at something like 250 tests. And if only one balance comes up on exam day, that is a lot of brain space you have wasted. The best way to do this is practice. So that is what we are going to do. And we are going to start with another question from the June 2015 exam, which is the exam paper from which we did 2 controls questions earlier on. It is June 2015. We've done question 2 and question 4, and I seem to be in the mood for even numbers tonight because now we're going to do question number 6. So just to prove I'm not making this up, there we go, June 15, all the way through to the end, question number 6. Now I like this question for several reasons. It is a real substantive procedures festival of fun. Because part A of the question asks you to identify and explain 4 financial statement assertions relevant to classes of transactions and events. Well, that's the statement of profit or loss. If it had said balances, well, that's assets, liabilities, that's statement of financial position. And for each assertion, describe a substantive procedure for the audit of revenue. And revenue, of course, is on the statement of profit or loss, which helps to prove what I've said must be correct. We need assertions for profit or loss, and then, well, with 8 marks in total, there must be 4 marks for that and 4 marks for that, which means we need 1 test for each assertion that we've put in part 1. Given we know there are more than 4 assertions, there are 6 for profit or loss, I suppose we want to pick 4 assertions for which we can come up with a test. Now, I think this is potentially quite a difficult question because you've got to understand 4 different assertions, otherwise the tests you come up with won't match the assertions. That's quite tricky, I think. And then, in the second part of the question, it's again substantive procedures. You would perform to obtain sufficient and appropriate audit evidence in relation to each of the above 3 matters. We've got 3 scenarios. So we're testing 1 balance in the accounts in part A, revenue, and she has specified the assertions, which makes it harder, and we've got scenarios as well. So this is ticking pretty much every box for how substantive procedures can be tested, which means this is a great question to practice. It covers pretty much every angle you need. So we need 4 assertions relevant to profit or loss, and then we need 4 tests on revenue. We need to explain each of the assertions that we're going to be using. So let's pick 4 assertions that we can explain and that we can come up with a test for. So I would start with completeness. What does completeness mean? It means every item that should be included in the profit or loss has been included. So nothing that should be in there has been missed out. And then we apply it for revenue. Which items should be included? The revenue you have earned. How do you earn revenue? Typically when you send the goods to the customer. So I would select GDNs, goods dispatch notes, from during the year, find the corresponding sales invoices, and then you've got to make sure those invoices have got into the revenue figure. So I would inspect the sales daybook, where all the invoices get posted and added up, to verify these invoices are included. And check that the sales day book totals match total revenue in the statement of profit or loss. Now I knew that was coming back. I have probably gone further than virtually any student on exam day would in explaining that test. I've really gone for the detail as much as I can. But I hope that as you read through that and heard me talking it through, you could see why that was a test of completeness. And that's part of the reason I've written it in so much detail, to make sure you get it. Second one. Having done completeness, I am tempted to do the opposite, which is occurrence. This is a test that every item that is in the profit or loss is a real event or transaction that did happen for this company. In other words, when I test occurrence, I'm doing the opposite of completeness. I'm now starting with the things that are in the accounts and making sure they should be there because they are real. So, for revenue, what would I do? I would pick invoices from this year's sales daybook. And what I should have done a bit earlier is done that, because then I can call it SDB as long as I like. Find the goods dispatch note and verify goods were delivered to customers during the accounting year, which would prove that those sales did occur. I could go a bit further and say we ought to also check credit notes to that customer to make sure that that transaction wasn't then reversed afterwards. But that should be enough on the F8 exam to get you your mark. Third one I'd go for cutoff. Cutoff is a sort of extension of the occurrence issue, where we're trying to make sure that around the year end, when goods could leave on one day and be invoiced on another, that the timing of this has hit the right accounting year. So events and transactions recorded in correct accounting period. So for revenue, what would I do? I would pick the last, let's say, 20 goods dispatch notes before the year end. Find the invoices for those and ensure they are in the sales daybook before the year end. I would then pick the first 20 goods dispatch notes after the year end. I would find the invoices and I would ensure they are not in the sales daybook before the year end. And that is cut off. This is going nicely. Now, classification to me is a bit boring, especially with sales revenue. I mean, there's only one number, revenue, so what would you test? So I doubt I'd go for that. Presentation is also fairly boring. So what am I left with? Accuracy. I need to test the numbers. Accuracy is a check that the correct figures for each, for each event or transaction are in the profit or loss. So anything that is checking the numbers is going to work here. So for revenue, I think I would pick a sample of invoices and redo the calculations, including discounts, VAT, to verify that they are correct and match the entries in the sales daybook. There you go, 4 tests for 4 assertions. Job done. But you have to match the tests to the assertions in your answer to show that you understand them. And that's the sort of thing you need to practice. Frankly, I would repeat part A and get rid of revenue and do it for purchases. Do it for non-current assets. Do it for inventory, receivables, payables, bank and cash. Just repeat for as many things as you can. And then we get part B. 3 scenarios worth 3 marks, 4 marks and 5 marks, meaning we will be looking for 3 tests, then 4 tests, then 5 tests. And it says, Hawthorne Enterprises manufactures and distributes fashion clothing to retail stores. Very exciting. Its year end was the 31st of March 2015. This exam came up June 2015, so we are a month, hang on, March, April, May, June, 2 months and a little bit after the year end. You are the audit manager. Year end audit is due to commence shortly. Yeah, after the year end, that makes sense. The following 3 matters have been brought to your attention. Hawthorne receives monthly statements from its main suppliers, which is usual, and although these have been retained, none have been reconciled to the payables ledger as at the 31st of March. They've not done their control procedures. The engagement partner has asked the audit senior to recommend the procedures to be performed on supplier statements. So we need 3 tests on supplier statements. If the controls haven't been done, we will need to get our evidence, of course, by doing substantive procedures, hence the question. I always like to write the number of marks when I'm doing the answer to remind me how many I need. I need 3 tests. Well, the most obvious thing to do, surely, as a starting point, if the client has not done it as a control, we will do it ourselves as a substantive procedure. So reconcile the supplier statements to the purchase ledger balances as at 31st of March 2015. Always say why you are doing things to verify the balances agree. So we're checking valuation of the figures on the purchase ledger to make sure those numbers look right. But we need 2 more tests. What if the figures don't agree? Well, if they don't agree, we need to understand what the problem is, and is the supplier wrong, or is our client's purchase ledger wrong? We are 2 and a bit months after the 31st of March. Surely, if the figures did not agree, if there is any sort of problem, there would be some correspondence between our client and the supplier where that problem was discussed and hopefully resolved. So the first thing I would do is I would inspect a document, correspondence, between my client and suppliers to see what dispute was and whether it's been resolved post-year end. But I'm also thinking supplier statements are monthly, which means if there was one at the 31st of March, there would be one at the 30th of April and the 31st of May, and both those dates have passed. So I would also inspect the April and May supplier statements to see if the supplier corrected their figures. Because if the supplier corrected their figures, it would tell you that the purchase ledger at the year end was fine and it's a supplier's mistake. So that's what I'd do for my 3 marks. Quite difficult that, because it's a very specific thing. You're not testing trade payables, you're testing just the supplier statements relating to trade payables. So it's a very limited story. Not nice. I do not like that question at all. But guys, it's only worth 3 marks. There are 2 other stories worth more marks than that. So let's have a look at the second one, worth a slightly more attractive 4 marks, and see what it says. Bank reconciliation. During last year's audit of Hawthorns Bank and Cash, significant cut-off errors were discovered, with a number of post-year-end checks being processed prior to the year-end to reduce payables. Ah, that old trick. You write the cheque and then you put it in the cash book that it's been paid. You then stick it in your desk drawer and don't send it to the suppliers until a few days later, because you don't have the cash, you don't want to pay it, but you want to make it look like it's been paid to bring your payables balance down. The finance director has assured the audit engagement partner that this error has not occurred again this year and that the bank reconciliation has been carefully prepared. The audit engagement partner has asked that the bank reconciliation is comprehensively audited. Right, so we have got to audit the bank reconciliation. Again, quite a specific question for which we need 4 separate tests. Picture in your head a bank reconciliation. It's a document that says here is the balance for the year-end cash book and here is the balance on the year-end bank statement, and here are the reasons why those numbers are different. Well, there's 3 things to test then. Balance per cash book, balance per bank statement, and the things in the middle. So I would want to check that the balance per cash book on the reconciliation matches the cash book balance at the 31st of March. So go and make sure they've started with the right number at the top, and then check the balance per the bank statement on the reconciliation matches the bank statement dated the 31st of March 2015. And I'm now thinking maybe I can get away with this. I'm not sure if this is two separate tests, because I also write to the bank at the year end and get them to confirm year end balances. So maybe if I compare that number to the bank letter confirming year end balances at the 31st of March 2015, maybe the lovely person marking my script will give me two separate marks for that. But I'm not sure, so I'm going to try for 5 tests, not 4. Right, the numbers in the middle of a bank reconciliation are typically payments the company claims to have made which have not hit the bank yet, or money the company claims to have received which has not hit the bank yet. And in both those cases, if they're telling the truth, those things should be clearing on the bank statements at the beginning of April, just after the year end. So I would inspect April bank statements to verify that any uncleared checks and receipts on the reconciliation are clearing the bank early in April. If it's taking a while to clear, maybe those things didn't happen in March, they happened in April, and the company is telling lies. Naughty, naughty. And the final thing I would do, which is pretty basic, AEIOU. I've got a bank reconciliation in front of me, AEIOU, recalculate. I would add up the bank reconciliation to verify the calculations are correct. Now, again, that is difficult, but when the audit of bank comes up in a substantive testing question, everything I've written up there would be in the answer. This one is just bank reconciliations, but bank comes up on a relatively frequent basis, and I'm good at this because I've just answered that question so many times. It's pure repetition. You can learn all of the tests, but I think the easiest way to learn them is to picture in your mind what a bank rec looks like. You've done one, haven't you? You know. And finally, to finish this baby off, receivables. Hawthorne's receivables ledger has increased considerably during the year, and the year-end balance is 2.3 million compared to 1.4 million last year. Finance Director has requested a receivables circularisation is not carried out, as a number of their customers complained last year about the inconvenience. Great. The engagement partner has agreed to this request. Well, there's one test you're not going to get a mark for then. You can't ask the customers. And tasked you with identifying alternative procedures to confirm, assertions coming, existence and valuation of receivables. How do I know that the year-end customer balances exist? And you're not allowed to enquire of three, the third parties. Got to come up with something else. How do you know those balances exist? Well, if I can't ask the customers, another way of knowing is if those balances existed on the 31st of March, at least some of those customers should have paid by now, because it's now the start of June. So why not inspect post-year end bank statements and cash book to see those customers who have now cleared year-end balances. Now, I've said existence. That would also help test the value as well, I suppose. Right. What if they've not yet paid? Pick a sample of year-end receivables and agree any invoices on those sales ledger accounts back to the actual invoices and goods dispatch notes to verify the sales have been completed. Now, I mentioned earlier on there's always the risk that the sale has then been cancelled afterwards. Since I need quite a few tests here, I would then say inspect post-year end credit notes, trace back to invoices, and if those invoices are pre-year end, ensure that they have been removed from year-end receivables. Well, there's 3 tests of existence. Well, if I'm checking valuation, if I've checked back to invoices, that's also valuation. If I've seen post-year end payments, that's also valuation. But when I think valuation of receivables, I think bad and doubtful debts. Therefore, I would inspect correspondence between client and their customers for any evidence of disputes. That might mean that year-end balances never get paid. And if I can't see any correspondence suggesting a dispute, the amount has not been paid, I need to assess the likelihood that that's a bad or doubtful debt. And what I'd like to do is something analytical. I would like to review the payment histories of customers with old balances to see if they usually pay late or not, because that would help to identify if an old balance is a problem or just a customer who always pays late. There you go, 5 tests. I think that is quite a difficult question. There's a lot of assertion work going on in there. I don't think the 3 stories you've been given are particularly helpful in coming up with ideas, because there aren't really any facts in the story you can test. That is a nasty substantive procedures question, which of course makes it a very sensible thing for you to practice. Better you practice the harder ones, then on exam day it will feel like a walk in the park, skipping along in the flowers. Okay folks, I've gone past my allotted time and I'm about to do serious damage to an air conditioning unit over there. So I think we should bring revision class number 2 to a close. We're doing well, guys. We're halfway through revision and we've already had plenty of exposure to all 3 of the big core areas. There's more practice of that stuff coming, plus a lot of other things we've not looked at yet that are not quite as important, which is part of the reason I'm leaving them until the later sessions, when of course we're closer to the exams. You need the core stuff as soon as possible. Thank you all very much indeed, and I will see you again for revision class number 3 very soon. For now, good night.